Buying a home is the American dream. However, with the high interest rates, this dream can quickly become a nightmare. In this video, I'll be talking about how to pay off a home in spite of the high interest rates, and I will give you access to a spreadsheet that will show you how to save thousands of dollars in interest. So let's dive into it right now. The average family today does not have $300,000 in cash to be able to buy a home. Therefore, a loan is needed. Typically, when you apply for a home loan, the bank will offer you a 30-year loan term. Just keep in mind that the longer the loan term, the more you will be paying for the house. Let's assume you are going to try to buy a $300,000 home at a 7% interest rate. On a 30-year loan, you will be paying for this house $718,526 by October 1st of the year 2052. That includes all the interest for the entire term of the loan plus the value of the home. You will only pay for all of that if you keep the loan for the entire term and make no additional payments. But there is a problem with this type of loans. As you know, the average American family doesn't stay in the same home for a very long time. So as soon as some equity is built, they decide to sell and use the equity to buy a better, bigger home and start the 30-year loan all over again. This is not conducive to pay off your home loan. Now let's dive into how to pay your mortgage off sooner and saving thousands of dollars in interest. There are a few options available to you when paying off your mortgage. Now let's take a look at the graph on the screen. The first line shows a conventional 30-year mortgage. The monthly payment is $1,995.91 and the amount of interest paid to the bank is $418,526.69. Keep in mind that in all of the options here, the loan amount is $300,000. So for a 30-year loan, the total amount of money you would have to pay at the end of the loan term will be $718,526.69. I don't know about you, but paying more than double on a home because of interest is not cool with me. Line 2 shows the bi-weekly payment. By doing one thing, you can save thousands of dollars in interest during the life of the loan and cut way back on the time it takes to repay the loan. Here is how this plan works. First, divide the monthly payment in two. So you take $1,995.91 and divide it by 2. The new bi-weekly payment is $997.96. This way, you don't have to make a payment each month. Instead, you will be paying twice per month or once every 2 weeks the amount of $997.96. By doing this simple thing, you will reduce the length of your loan by 6 years and 4 months and save almost $105,000 in interest. If you are already on a mortgage and your bank does not allow you to make bi-weekly payments, all you have to do is divide your current monthly payment by 12 and add that amount to each month's regular payment. Just make sure to write on the memo of your check or on the stub they provide that the extra amount is to be applied to your principal. For a 30-year, $300,000 loan at 7% interest rate, to continue with the same example we have been using, you will take $1,995.91 and divide it by 12. That will result in $166.33. Then you will take $1,995 plus $166, and that will give you a total of $2,162.24. This new amount is the total you need to mail every month in order to achieve the almost exact same result. The numbers will vary a little bit, but not much. The fourth line on the screen shows the 15-year loan. So notice that the difference in the monthly payment for a 15-year loan compared to a 30-year loan is $700.57, meaning that if you pay $700 more every month, you will reduce the term of your loan by 15 years. Not only that, if you can afford this jump in the monthly payment, not only you reduce the loan term, but you will be saving more than $233,000 in interest. You're probably thinking, Sandra, you're crazy. Most people cannot pay $700 more towards their monthly mortgage payment, and I'll say you are right. However, if you decide to buy a starter home instead of a $300,000 home, the numbers dramatically change. Let's assume that the very first home you buy is valued at $150,000. For this example, on a 30-year loan paying bi-weekly, you will save $52,443 in interest. On a 15-year loan paying bi-weekly, you will save $130,336 in interest. Now, if you decide to go this route and stay 15 years in your starter home, take care of it and update it as needed, by the end of the 15 years, you will have more than enough equity to upgrade. Ka-chin! Now I'm going to show you how an amortization schedule looks like so we can use it to your advantage. This schedule has 7 columns. The first column is the number of the payment starting with number 1 and ending with 360 because it's a 30-year term loan. The second column has the due date of the payment. The third column shows the monthly payment amount, which is always the same, $1,995.91. The fourth column indicates the amount of interest you are paying with each monthly payment. The fifth column tells you how much of the payment is going towards the principal. Notice that the interest is super high compared to the amount that actually goes towards paying your loan off. The seventh column is the balance that indicates how much you still owe the bank after that particular payment has been applied to your loan. Now let's analyze the first line. Notice that your first payment is due on November 1st, 2022. And when you make that payment, $1,750 goes to the bank as interest, and only $245.91 goes to your actual loan, leaving an unpaid balance of $299,754. Even though the way your first monthly payment is applied to your loan looks very discouraging, having this info can benefit you if you learn how to use it to your advantage. When the bank calculates the interest on your loan, they do it on the loan balance amount, so paying a bit extra every month gives you tremendous rewards. For example, by paying your first payment of $1,995 on November 1st, 2022, keep in mind that $1,750 of that payment is just interest and $245 is the amount that is applied to your principal. What you can do is add to your first payment the amount of principal for the second month, which is $247.34. This way, you are paying your second monthly payment in full, which results in saving $1,748.57 in interest. Now, instead of paying the second month the following month, you will actually have to pay the third month. Ka-ching! So what happens at the end of 12 months when you make only your exact monthly payment each time? You would have paid the bank $20,903.46 in just interest and only $3,047 in principal. If hypothetically you are able to pay along with your first monthly payment $3,047.43, you would have saved $20,903 in interest. Now, that's the kind of return I like. This is a 633% return on investment. Maybe you are not able to start doing this right off the bat, but what if you start as soon as you are able to make those extra payments? You will be saving money big time. Ka-ching, ka-ching, ka-ching! Let me just say that your IRA or your tax deduction every year because of the interest paid on your mortgage does not amount to these savings. Just saying. The amortization table I use is excellent because it lets me know exactly how much money I'm saving every time I pay a little extra on my mortgage. Column number 6 in this table is called additional principal payment. Let's say I decide to start making one extra payment per month. Notice how if I don't make any extra payments, my loan balance after the very first payment is $299,754. By paying the principal amount of payment number 2 at the same time I send the very first payment, in this case $247.34, my numbers immediately change and my new loan balance is $299,506. My amortization table is telling me how my loan changed because of that extra payment. Now I can proceed to add $250.24 to my monthly payment number 2. The number changed again, and let's make another extra payment on month number 3 of $253.16 as the schedule shows. If I scroll to the top of the amortization schedule, I can see that I saved myself $5,236.97 in interest and reduced my loan term by 2 months. How cool is that? If you would like to receive a copy of this amortization table, make sure to click the link on the description of this video so I can email it to you. Let me add that by using your loan amortization table, you can start saving thousands of dollars in interest even if you are in year number 20 of your loan term. Don't let anybody convince you otherwise. Now let me give you some tips when it comes to borrowing money. Tip number 1. Borrow as little as possible. The smaller your loan amount, the less you will be paying in interest, fees, etc. Try to come up with as much down payment as possible. Tip number 2, have a fixed interest rate. Try and avoid having a variable rate because if the rate increases, let's say by the 3rd year of your long term, then the interest you will be paying also increases. Tip number 3, choose a loan that has a smaller term. If you can afford the monthly payment, try to do a 15-year instead of a 30-year mortgage. You already saw the benefit of selecting a shorter term, which is saving you thousands of dollars in interest. Tip number 4, ask your loan officer for a loan with no prepayment penalties. Meaning if you pay extra, as I explained in this video, the bank won't penalize you with more fees or to pay the interest anyway. Tip number 5, shop for the interest rate. Try and visit at least 3 lending institutions to make sure you are getting the best rate possible and the best terms. Remember to click on the link in the description of this video to receive the spreadsheet or amortization table in your inbox. Thank you for watching. Leave me a comment letting me know how much money you are saving on interest by using this amortization table. I'll see you next week.